This episode is sponsored by Lens Protocol. Lens lets you own your own social media presence, easily monetize your content, and carry your social graph with you wherever you go. That means you, the creator, can focus on creating without ever having to worry about losing access to your account or having to build a new following again. Lens also lets you engage more closely with your fans, directly monetize your work, and if you're a dev, easily spin up a new app with Lens's full suite of developer tools. Go to lens.xyz today to claim the last social media handle you'll ever need. Hey everyone, welcome back to Rehash, a Web3 podcast. I'm your host, Diana Chen, and today we're speaking with Maya Bakhai, founder and general partner at Spice Capital, an early-stage venture capital firm that is funding businesses solving problems for the next generation of internet-native consumers. Maya founded Spice Capital in October of 2021 with the goal of adding some spice to the predominantly white, male-dominated field of venture capital. Recent stats show that less than 3% of all VC money goes to companies founded by women, and less than 15% of all investors are women. Maya taps into her previous experience at PwC and 35 Ventures, the VC firm co-owned by NBA star Kevin Durant, as well as her personal experiences and perspectives as a young female person of color to identify promising new opportunities and make investments into initiatives that traditional investors might miss. Spice Capital is backed by big names like Mark Andreessen, Chris Dixon, and Alex Ohanian, but it also benefits from the perspectives of a diverse group of investors, which is made possible by the unique way in which Spice is structured. While most VC firms require a minimum buy-in of $250,000, Maya has reduced that number to as little as $5 for investors from an underrepresented group. In my conversation with Maya, we talk about why she chose crypto, community, and capital as the three main categories for investment for Spice, what she believes is the largest unsaturated market in Web3 investment right now, how she sees the creator economy evolving in the future, and much more. Maya was nominated by me, Diana Chen, and voted onto the podcast by Zaji Reyes, David Phelps, Daisy Alioto, Brenner, LDF, Triumph, and Andy Boyan. I can't wait for you all to hear my conversation with Maya. Hey, Maya, welcome to the podcast. Thank you so much for joining us today.
Thank you for having me. Very honored.
Of course. I know some of your portfolio companies have been on before. Daisy Alioto from Dirt, Tom from Lore is coming on later this season. So I feel like there's this whole big Spice Capital family now on Rehash, which I'm really excited about.
Me too. It makes me happy. Even the sentence Spice Capital family, it's like, whoa. Yeah, it's awesome.
It's a family. We're all a family now. So I want to jump right in. Spice Capital, something that you guys have on your website and your Twitter bio is that Spice Capital is funding businesses solving problems for the next generation of internet native consumers. So I just want to start by kind of dissecting that a little bit. First of all, when you say internet native consumers, is there a particular demographic you have in mind? Like, are we just talking Gen Z and younger who were basically born into the internet, or would you also count millennials like myself who, I've known the internet for most of my life, but I still do remember a time without internet. What demographic are we talking about there?
Yeah. And I think it's a pretty broad term, but I also feel that the way I think about it is internet native means you're spending a majority of your time on the internet, right? And so you've grown up spending a majority of the time, whether we're Gen Z or millennial or even someone that's my mom's generation, still today they are spending, if you look at their screen time, more than 4, 5, 6 hours of when they're awake on the internet. And so what I really mean by that is, how do you actually think about new principles of designing businesses? How do you actually think about the behaviors that we've grown so accustomed to that we don't even realize anymore? We're comfortable connecting with people online, one-on-one. We're comfortable watching a concert on YouTube instead of going to a concert. We're comfortable sending payment without knowing someone over the phone. All these things didn't exist even 10 years ago, even 20 years ago. It was a novel thing. And it's become so natively part of our culture. The way I think about that thesis of types of companies I back is, once you have those principles embedded in you, you're not even realizing it. The businesses that started 20, 30, even 10 years ago that built for a different set of consumers that maybe spent 1 hour online or 2 hours online per day, they're going to become obsolete, or they're going to have to make massive change to keep up with the the demand and the changing state of the world. And so it's a broad sentence for sure, but like it identifies how big of an opportunity there is as well. We are in a very fast moving, fast changing world, and it's best to be very hyper aware of it.
Totally. And I love that framing. And I love that you're not just sort of boxing that into a specific demographic and age group of people or even a locale of people, but it can really encompass anybody from kids today all the way up to our parents or even grandparents who are really tech savvy or just spend a lot of their time online. So when you think about people that spend a bulk of their time online, what do you see as some of the main problems and maybe like the main categories of problems that people are facing today, this internet native consumer base? And how do you see that evolving over maybe like the next 10 years?
Yeah, I think the biggest problem, ironically, is that we have so much freedom online. Like you almost like enter the internet and you're in this universe and you can get served content that you love. You can meet anyone in the world. And yet a lot of Western society, which probably has the most exposure, feels really lonely. Like they feel like, oh my God, I can find 1,000 people that share my interests of this niche meme, but I don't feel that sense of community. And so I think one thing that's really a problem that I'm noticing is we have like unlimited freedom, unlimited upside. We have these beliefs where like anyone can become rich, anyone can become famous. And on the other side, you have people feeling really isolated. You see that people aren't getting married as early, like they're not having really robust friendships and friend groups. You're seeing younger people deal with anxiety and isolation and depression and mental health declining. And so something has been built incorrectly, right? Like theoretically, if you give someone more access, you would hope that they would take advantage of that and live a happier, more fulfilled life. They would have a higher income or they would have more connections. And, like we have infinite connections and still feel lonely. It's like, to me, that's a really big pillar because that's what drives social psychology and it drives culture as well. Like a lot of the brands and businesses that are able to take people and make them feel like friends and make them feel good and give them this like warm-hearted feeling are really succeeding. And so that's for me, the biggest lens, I guess, in which I look at opportunities. Like, are you solving this core problem of loneliness in this hyper information overload world?
What are some of the solutions you've seen to that? Because I think that's something we're all very much aware of is this paradox of we're more connected than ever, but we feel lonelier than ever before. So how does that work and what are the solutions?
Yeah. And I mean, that's my job. Like I'm like searching for those every day. There's one company that I backed called Moonlight, and they are a tarot marketplace and tarot community. People are using it for tarot therapy. It's really interesting. Like people are opening up to random others and saying like, here's my challenge, or here's an obstacle I'm facing at work or in my personal life. And then they're literally coming together all of a sudden and solving each other's problems, asking prompting questions and forming this really good bond. And to me, like that's a really good example of, okay, strangers on the internet who actually went one level deeper besides just superficial, like, hey, I'm into this thing or I'm into this visual aesthetic, and said, like, let me open up to you. Like, let me almost serve as a guide, and people are guiding each other. So it's like experiences like that really kind of help to tip us on the other side of this paradox.
So do you think in the future that it'll be less about these big platforms like everybody's on TikTok nowadays or Instagram or Twitter, but more so about these niche communities, like a tarot community? Like that's super niche. So do you see in the future that communities will revolve more around shared interests like that or shared experiences that are a lot more niche than we're seeing today?
Yeah. So I think, I mean, you're already seeing on TikTok, right? Like you're seeing the mini trend kind of take off. Like you have these micro trends that will be really relevant for an amount of time and then people move on to the next trend. I think the opportunity is like kind of doing a value capture when there is a micro trend. So if there's a micro trend around a fashion piece, right? So whether it's like, hey, there's a specific bag that everyone wants and everyone's obsessed with and they love the history of it and they've studied it. The company that will do really well or the platform that figures this out is the person that will say, okay, there's a mini trend. Let's take the best people from there and then connect them on a deeper level. And then now we can create a business off of that, right? Because like we know exactly what their interest is. We know exactly the qualities they prioritize and let's monetize that. And I think there's a lot of opportunity around taking these, it's almost like bundling, unbundling, honestly. Like we went from a world of big social media brands to now it's an individual first world. Like you can choose your own adventure when you participate in the internet. And then you're going to see companies that say, okay, let's aggregate all these niche communities. Let's give them the best tools, best offerings, and then rebundle them up eventually. Like someone will come again in 10 years and say, oh, there's a lot of these niche communities that have these micro businesses. The way I think about it is this is the next evolution. This is like the digital SMB, right? Like what does that mean? Like your local coffee shop is now maybe this small niche community, and someone is going to figure out a business model to make that sustainable. And then somebody like a PE firm will come and roll all of those up and say like, hey, we can have more efficiency if we combine all of these. And so right now I think we're in an interesting space because we're like in the unbundling where like big media is getting disrupted and big tech is getting disrupted. There's a lot of these niches, but then we're also like in the beginning stages of the rebundling of a lot of the companies that do creator economy, right? It's like Patreon essentially said, hey, every single person go find your 1,000 true fans and we'll be the platform and serve a lot of you at once. And so you're seeing both sides of the spectrum. So it's a cool place to be as an investor because you have opportunity on both sides. You still have a lot of opportunity for legacy industries, and then you have a lot of opportunity on the new side of like identifying the niches and the solutions that make a niche business scalable and profitable.
When you talk about bundling and unbundling, are you talking about the platforms themselves? Like, do you think we'll see a bunch of different apps for a tarot card community, a different app for a really niche fashion community around a particular designer, another app for something else, and then maybe like longer term, we'll see all of these come together in one? It's something I've thought about a lot because in my personal life, I'm part of a bunch of different hiking communities, or sometimes when I want to go and do a big hike, I'll try to find, like trail reports from people who've done it recently. And the place to do that is actually Facebook, which no one uses Facebook anymore. And I don't either, but that's just where these communities are. And I found a lot of super valuable groups on Facebook for specific mountains like Mount Whitney, Mount Rainier. People will be posting exactly what the trail reports are that they just went yesterday. And there's really no other way to get such a real-time update about what the trail reports are. And that kind of makes me think like Facebook is such an antiquated platform. There's really nothing to boast about the platform itself, but it's still this really useful tool because that's where people are. Almost makes me think that the platform itself doesn't really matter at all. Like I can talk about how antiquated Facebook is and how only grandmas use it, but I'm still on it because that's where these communities are.
Yeah, definitely. I mean, I think the platforms have the distribution advantage, right? In the first evolution, everyone focused on distribution and focused on, oh my God, like it was a wow moment. You can connect the world. You can connect with anyone. I think the value is shifting to the actual content. And so if enough people wanted to be on that Facebook hiking group, and if the moderator had leverage and they were like, hey, you know what? I can monetize this, or I want to do a summit, or I want to do a group hike, or I want to do a conference, or I just want to invite someone over to my house. Like there's no way for me to contact them. If there's enough strength within that group, they will peel off and just go direct to consumer. And I think that's the trend we're moving towards now, that like you said, Facebook gives you like the touch point. It's almost like the top of funnel, or whether it's Twitter, Facebook, Reddit, it gives you the top of funnel. But then to actually go the level deeper and to solve this loneliness issue, you need to own your audience or your consumer or your customer, whatever that word is, directly. And that's where there's a really big opportunity, whether it's with crypto, whether it's just using other types of tooling. I think we're moving towards that.
Yeah, absolutely. That makes a lot of sense. Something else I wanted to talk to you about is Spice Capital. I read your thesis on your website, and the three main categories that you guys invest in are crypto, community, and capital. And having spoken to you for the last 15 minutes or whatever it's been, I understand that community piece 100%, like why that's super valuable to you guys. And then capital is sort of like you have to make money, right? And then this crypto piece, like I'm wondering where you see crypto being a solution to this problem of us being more connected than ever on the internet, but still feeling lonelier than ever.
Yeah, definitely. So the community you get, capital for me is this bet on alternative asset classes growing. I mean, I just read something where it was like, I think they said like almost 50% of Gen Z has invested, which is crazy. Like 18 to 25-year-olds, half of them in the US have made a stock market equity or crypto investment. And that just didn't exist like 10 years ago. Even when I was 18, nobody was doing that. So if you have a young group that's used to thinking about money, they're going to want better and better returns. Like it used to be just be passive and invest in the S&P 500, just buy Ethereum and Bitcoin. But as more and more people enter a new asset class, there's more liquidity, which means there's more information, which means all of a sudden people start chasing alpha. So I have this thesis that more and more people will start moving towards alternative asset classes, whether that's crypto, whether that's collectibles, whether that's handbags, like streetwear, whatever that may be. If everyone is investing in the S&P 500, people always want the better return, right? So that's kind of what my capital thesis is around. Like, we're in this state of financialization of everything, like it or not. You will see more. You already saw it. Like, every time there's a new asset class, people are flocking to it because they're chasing the return. And I want to fund businesses that are making that a consumer experience, that make it really easy for a young person to participate, the way Robinhood did for equities, right? And then the crypto piece is really tied back to the community. To me, I think right now there's so much pressure and there's so much uncertainty with some of these large platforms. Even I was deplatformed from Lyft. Like, my Lyft account randomly got banned. And I was like, what did I do? I don't understand. And it sucks, right? Like, imagine building an audience. There's a ton of people that are content creators that are doing this full time. Like, that is very much an industry, whether you want to ignore it or not. There are people making livelihoods doing content in your business, right? Like, media is everything. And then you're seeing them all of a sudden. I mean, number one, not owning their audience directly. That's insane. That would be like having a laundromat and like not having anyone's credit card information, not having any data on them. And in today's world, which is internet native, it doesn't align. And so I think there's this pressure as creators get more leverage to own their audience. And that's like a very simple thesis I have around crypto and a really big opportunity. So I'm really excited to fund projects that are thinking about the creator economy in a new way. Creator economy is definitely a buzzword in a lot of ways, but I think rightfully so. They're commanding a lot of attention. Kim Kardashian will promote something and the business all of a sudden will, whatever she promotes, will see like so much traffic, so much volume, millions of dollars of volume. You cannot ignore that. And so giving creators power and ownership is really compelling to me. And the other side is like thinking creatively about new business models. Like, maybe in the past, in a big tech, Facebook, Snapchat, Twitter world, the business model was pushed towards ads. What if you can actually incentivize your most loyal fan in a financial way? And that's not different than an affiliate program that's in Web 2. But what if you can do it in a way that's global, where you don't have an issue of, hey, my biggest fan is actually in London, but I can't get payments to them. And so I'm missing out on that whole audience because I'm sticking to America. And so like the mix of global payments and ease of financial transactions with ownership economy to me is really, really exciting. And like those are the types of projects I'm trying to back. And it is a long-term vision. Like, it's not going to happen immediately, but there's a lot of interest and demand. Like, it's pretty easy to pitch a creator and say, do you want to own your own audience? Like, why not? They would love to directly monetize.
Yeah, absolutely. I think another difference too between affiliate programs and how we can use crypto to incentivize creators is, I think affiliate programs feel very transactional to me. And this is as somebody that used to be a travel blogger and was a part of these affiliate programs. It feels very transactional. It's like you promote their link, somebody buys, and you get paid. This can end at any time. You can shut down your blog and decide to stop this relationship. They can close down their affiliate program and your relationship ends. Whereas I think what crypto enables is more opportunity for true ownership. So not only are you getting paid for promoting a product or a link from the brand, but that could also give you upside in other ways. That could give you upside in maybe helping them determine what their next product drop is, or giving input in their design elements, or attending their events. And I think these are things that just are more interesting than just like an affiliate program that we're used to seeing.
Definitely. But I think also like there are different types of consumers, right? Like there's always going to be your super fans that actually like saying, hey, I was early to this. I mean, it's the same in music or fashion. Like, I wore this brand or I follow this brand on Instagram early. Like, there's that crew. And then there's a crew that's just wants to make money. And I think there's room for both. Like, something I feel unsettled about in crypto is a lot of people assume that everyone wants to in the DAO structure that we're all familiar with. It's like everyone should participate in governance. Like, you don't have good participation, or people aren't showing up to your party. Like, there's this very binary way of thinking. And the reality is everyone has different incentives. Like, each consumer base has different incentives, and there's not one crypto native persona. There's very different nuances. And there's people that like literally just buy Bitcoin, the Uber drivers, your barbers. And when I ask them, why do you have crypto? It's like, because I want a chance to play the game. There is a game in the financial markets. If you're not from a certain background, if you're not educated, I want to participate. And this is my hedge to finally have a chance to play the game. And so you even have that that type of persona that I think there's this really big disconnect in like what I call like Web3, like crypto Twitter, and then other people who just own Bitcoin. I think they said it was that same Gen Z report I read said like 19% of Gen Zs who invest own cryptocurrency or an NFT, which is pretty high. And like a lot of them might just own it because they're like, I want a chance. And so you have to cater to your different market segments, not have this very strong point of view of what's a crypto person. And I think that's something that I think about a lot. And even when I'm talking to my founders and they're like, which consumer should we build for? I'm like, there are different types of consumers and customers that you need to be thinking about.
Yeah, I was kind of smiling when you were saying that because I literally just had this conversation with Sursu from Blackhand on episode 1 of this season. We were talking about how there are different types of community members. You have your super fans, and then you have, sort of your lurkers who are like very aware of your brand and everything you're doing, but maybe you're not aware of them at all because they haven't spoken up. And you have everybody in between. And that's totally fine. And it's like, when I think about the Rehash community, we have the people that are nominating guests and voting for guests every single season. And they're super stoked to be part of the governance process. Other people who are maybe too busy to participate or aren't as excited about it, but they help retweet everything that we post. Other people that will come in our Discord channel, which feels a little bit more private, and have a lot of conversations there. Or some people who just listen to the podcast and don't participate at all. And that's totally fine too. And every community segment is super valuable to us. And it's not like our goal is to convert all of our listeners into Discord server members or into governance members. You can participate at whatever level you want. And we're grateful and you're valuable to us.
Yes, totally. And I think that's something that I think a lot of crypto people have had to come reckon with, where the internet, forget crypto, like is very much, I said in the beginning, choose your own adventure. And then the culture of crypto, especially in like peak bull market, became a culture, but it almost left people out in a way because it was like, you have to say wag me, and there's a way we talk and there's certain things you do. And that's just not reality. And like, you have to be able to have high consumer empathy and understand that, no, there are different types of people. And so the founders that understand that and know how to market and serve different groups will be ultimately more successful.
I want to jump back to something that you were saying about the creator economy. I know you were talking about like Kim Kardashian and how she's built this brand around herself. I know she's a special case because she is already such a big name. But do you think in general that we're kind of shifting more towards individual creators becoming more of the center of attention, as opposed to, I think previously we would see more of the company or the brand being the main thing and then the person as the secondary?
I think there's opportunity for both. I think that the key takeaway is that no matter how you slice and dice it, whether it's an individual or a brand, the differentiator is that they're building media. They're doing media really well. Every business today is a media business. I talk about this with Daisy a lot. Like, she definitely has educated me on a lot of this, but I don't think it matters whether you're a brand or an individual. What matters is what your distribution strategy is like, are you multi-channel? Are you able to communicate with your audience and find your audience? Are you able to leverage a more algorithmic feed, whether TikTok, YouTube, to get to the right person at the right time and serve that content? I think that's the real special sauce versus is it a person or is it a brand? Because I think that, you'll see examples like Mischief does an amazing job. It's a headless brand, but they know how to storytell and they know how to pull people in. They know how to do viral hacks. You'll see like McDonald's Grimace right now. Like, that's crazy to me. That's a character. And like, there's so much content created. Like, they're almost memifying it. So I think everything is like, can you spin whatever it is into a easy thing that people remember? That's the marketing gimmick. And that's what Kim Kardashian did really well. She like memed herself. And I think people have taken notes from her and then done it in their way. And so I don't think there's one right answer, though a lot of people say we're moving towards, you have to have one person doing your TikTok. I think a lot of times if you're not headless, you run the risk, tactically speaking, if you're a founder and you want to create a brand or you want to meme yourself, as I'm saying, and you hire one person to run your TikTok, they could have burned out and now like that person's gone. And so you almost have to have something a little bit more than just the day in the life. That feels like very influencer 101, like get to know the person. I think we're past that. I think we're just like, what's the most entertaining and compelling story that I can resonate with? That's it.
Have you ever wanted to buy an NFT with a group of friends, crowdfund a project, or start a collective, and found yourself stitching together tools manually to help you make your dreams a reality? I certainly have, and that's why I'm excited to tell you about Lore. the Web3 co-ownership platform. Lore lets you seamlessly spin up a shared wallet, pool resources, and coordinate group activity all in one unified experience. Connect to dApps and make any transaction multiplayer. What you can do together is endless. Go to lore.xyz/rehash and start a collective today. Video powers the internet, but building with the most engaging form of media shouldn't be complicated or expensive. LivePeer's suite of developer tools, powered by the LivePeer network, make it easy to build performant video experiences affordably, at scale, and with no vendor lock-in. Designed to give developers the freedom to innovate, creators autonomy from platforms, and viewers a choice in their experience. Visit livepeer.org to get started today. HTML Tina, who we had on the last episode, had a question for you on Twitter. She wants to know, what do you think is the largest unsaturated market in Web3 investment right now?
That's a good question. Man, everything is really saturated right now.
I know. It's a tough question.
That is a tough question. Something that I think people aren't doing as much is physical products. In the last bull market, there were a lot of companies. I know there's like Artifact and a few others, but a lot of people talked about tracking stakes and like tracking physical things, tracking logistics. There was a lot of these real world use cases, and theoretically it was amazing, but I just haven't seen them come to market. My sense is that a lot of the founders claiming to build supply chain, I think a lot of those founders said they were going to do that, but really just wanted to launch a token and pump and dump. And so to me, again, having this secure encrypted ledger that's also has no middleman for things that are really high integrity, whether it's material sourcing, whether it's payment or salary data, all of these kind of real world use cases where you have massive databases theoretically would be great to be put on chain. But I think the founders that pitch that vision kind of rug. And so I think there's like a big opportunity doing real world stuff, physical products. And I don't see that many founders thinking about that because it's harder. It's definitely harder. But I feel like the whole industry is still trying to find product market fit. That's my take. And so like, if you're a crypto founder right now, you yourself as a startup are trying to find product market fit. You might have the standard odds. Let's say it's 1% chance you become $1 billion company. On top of that, you're in an industry that's a moving target that's trying to find its like product market fit. And so I think that if you're going to play that game, you're making the bet as a founder that the expected value of the bet of crypto taking off is so high that I'm willing to make this like double no product market fit journey. And I'm ready to dive in. And I feel like if you're going to take that bet, you should go as big as possible. Like it's easier to build a software or tooling for something you know already exists. Like think about what hasn't been built yet. So to me, the underserved opportunity is real world use cases. There are a lot of places where there's corruption, and like crypto is amazing for that.
Absolutely. I would love to see more of that myself as well, instead of these lofty goals. I feel like a lot of times founders in this space are building for themselves or for their friends who are also in the space and not really thinking about who is the general public. And I think a lot of times we can get kind of stuck in this, like this Williamsburg bubble or this Miami crypto bubble and sort of lose sight of what people are going through in the rest of the country and the rest of the world. So yeah, I absolutely agree. I wanted to ask you a little bit more about Spice Capital because I think the fund itself is super unique and creative and innovative and just awesome in so many ways. A lot of, I think, just the complaints that I hear about VCs in general relate to diversity and inclusion issues, that there aren't enough female and minority representation in venture funds, and also our venture funds fueling more inequality by continuing to fund the same types of companies and founders. We had Cami Ramos on last season, and she talked a lot about her thesis of why crypto needs to fund more founders and companies from emerging parts of the world instead of from North America and Western Europe. And I think that's totally along the lines of what you're trying to accomplish with Spice Capital. So tell people how Spice Capital is structured differently from other funds and how you got this idea in the first place.
Yeah, happy to. So with Spice, I just feel that if you're investing in a new category, if you're investing in startups, your job is to fund things that haven't existed yet. And I think it's really hard when, from like a top-down perspective, all the way at the top, when the person who's making the decisions of what's innovative and what's not is in a bubble or fits a stereotype. Because naturally, I mean, even I have biases, all of us have biases, but you need to start from the top and start removing some of those biases. And the way you do that is by bringing new people into the fold, right? So for me at Spice, I was like, okay, how do I do this? And it really started, let me back up. It started because I felt that even in the last bull market, the stock market was roaring, crypto was taking off. There were all these cool things. There were all these ways to make money. I participated and I would tell my girlfriends like, hey, buy this stock, or like, you should think about investing your money, or let's participate in this DAO so we can earn something. And again, it was all wealth creation. And I just saw like glazed eyes. There was no interest. Or I'd be like, oh my God, I just met with this amazing founder. Think like this is a crazy idea. No interest. And I realize a lot of this is cultural, where like women are just not used to talking about that. I mean, if you ever go to a party with your parents, it's like the dads talk about money and business and the moms talk about something else. We just don't grow up as women talking about money. It's crazy to me. And then on the flip side, I'm reading statistics of like younger people kind of shattering all of those barriers and like participating and trying to be involved and trying to hustle and becoming creators and finding ways to make money. So it's like there's this whole group of people, the kind of like millennials and older millennials who have access to capital, but are like not really participating in the ecosystem that's going to drive change. Yet they're complaining a lot on Twitter and social media about, oh, you know what, like tech isn't fair. Like we don't have enough women in power. But I'm like, the way to do that is go right to the source, which is like, where is the money coming from? And so for me, I was like, okay, I want to set up a fund. I'm a woman, obviously, and I think I will have a diverse perspective and I'll have a bit more empathy for a female founder. And I might be able to catch something that a male founder might miss. Like I invested in this IVF company called Kindbody, and we did an all woman SPV. Like we all invested together, and it was hilarious because so many dudes just passed on that deal because they didn't understand that people want to freeze their eggs, and it's an amazing return now. And they just missed it because they're like, healthcare is hard. I don't know if people will really do this. I'm like, you're not part of the population. So I think that's important. On top of that, so I said, okay, I'm a female GP. On top of that, I said, I want my investors to be majority female as well, or people of color, like people who don't participate in venture, who have no clue what's going on. I want them to be involved because I want them to read my investor updates, see how cool it is, see how like exciting it is, and participate. I want them to be the early adopters, not the San Francisco white male tech bro. There's enough of those early adopters, and it's becoming an echo chamber. And so that was my intention. So my fund was set up where, you know, I dropped the investment minimum for anyone that's a woman or a person of color so that it reduced the friction to enter. I have a lot of investors, like over 100 investors, and I'm trying to hit every single element and go kind of top down and bottoms up to create a more equitable future. Because if I can make these people money, let's say they don't think anything is cool. Let's say I send them a bunch of investor updates and they're like, we don't care. This is not interesting to us. It's too technical. But they see, oh my God, I put in 10K and I just got 100K back. Like if they see that, people pay attention when you have money. Like a lot of people, even in crypto, their first entry point was because they bought Bitcoin and all of a sudden it went up and all of a sudden they became like the like spokesperson for crypto, right? And so I was like, if I can even do that, like I've achieved a goal because now I have created 100 people that have this new wealth, and they now can think about how do we pass it forward? How do we build an ecosystem off of this? And I want those 100 people to look really different than what Silicon Valley looks at like right now. So that's kind of the like ethos of Spice. And then naturally, by having those types of people as my LPs and my advisors, I'm almost forced to reckon with some of the BS that happens in the industry. Like when I write my investor update and I'm typing out a company that I want to invest in and it falls within that echo chamber, I almost have to think of my audience, which is my investors, and say like, are they going to get this? Are they going to even understand what this means? Will they be able to call BS? Like, hey, Maya, I think you're getting caught up in the hype. And so it almost checks me a bit because I have to think about the mainstream consumer always when I'm making an investment. What will they say when they hear I invested in this deal? And then on the other side, I just see female founders point blank. It's way harder to raise. I don't lead rounds, but the leads, I've seen this happen so many times. Like a male founder with the exact same product and same technical background will get a higher valuation. It's the same for my fund. It's something like the average first time female fundraise manager will raise anywhere from like $2 to $5 million. And for a dude, it's 20. These were bull market stats, by the way. So I just feel like, okay, I'm going to do my part. So I'm going to find women that I think are undervalued and give them a shot because a lot of people don't want to be the first check into a female founder. And there's a very, very strong bias. And I think if I can help 5, 10, 15 female founders build billion-dollar businesses, they now have the power to go support more women. And it's like this chain effect. And so that's how I'm thinking about it in very, very deep detail.
Those numbers are just wild. I'm still kind of in shock from that. You mentioned earlier the IVF company as an example of some of the stuff that you might be able to see, or your fund with a lot of women and people of color might be able to see that white dudes from Silicon Valley might not be able to see. That's like a very specific example, but I'm sure there are so many more examples in even broader ways. To me, and tell me if I'm wrong about this, but it seems to me like a lot of that probably has to do with culture and just being able to spot culture in a different kind of way as a younger female person of color. Would you agree with that? And I guess like I'd love to hear you speak more broadly about the importance of culture in Web3 companies, especially compared to Web2 companies, because I know you were previously a VC at a traditional non-crypto fund. How do you see the importance of culture change in the Web3 space, whether for better or for worse?
Yeah, I think the culture, a lot of it is around how people are building. I think the way they're building businesses is really different. A lot of companies that were built in Web2, for example, when you are a founder, I feel like every single person, every founder will go to like YC startup school. And then there, the premise is lean startup, find product market fit, keep iterating and shipping. And the advice you read, the blogs you read are very much around, can we create something that drives value and ultimately enterprise value to our business? And I noticed that in Web3, a lot of the first-time founders getting funded were backed by these investors who were people who just bought Bitcoin and all of a sudden had $100 million net worth, knew nothing about building a startup, became thought leaders and investors, and are now funding cool ideas that have hype. Like hype was the North Star. And I noticed this in a lot of founders where they were building for their next financing round or the most hype possible. And that's so different than in Web2 startups where it's like, you know, a B2B SaaS company like has to get to X million ARR, or if you're a consumer, you have to get to 100,000 app downloads or no one will take you seriously. There's no KPI that people are really moving towards. So it makes it really, really difficult for a first-time founder to know where to go. And if you're young and you don't have guidance, there's no like YC handbook for Web3 founders. It's like completely undefined. I think a lot of what I try to do is kind of level set everyone. And I don't know the answers either, but like I'm kind of trying to crowdsource from all my founders and other founder friends and come up with like baseline guides. Like maybe we focus on this market share. Let's set some revenue targets. Let's set some growth targets. Brick by brick, that is how you build a very sustainable long-term business versus let's create the coolest brand, do a bunch of like GMs, threads, airdrop, launch a token. That model doesn't work. And I think that the culture of startup building needs to change in Web3. I think companies need less capital upfront. I think they should be shipping more. I think they should be focused less on brand and hype. Brand is important, of course, but less on the hype that they were trained to. And I think a lot of that fault is some of the bigger investors that carelessly gave them money because they're like, oh, this person will launch a token and we'll get 1,000x. So that's something like I think about a lot. Like, how do you make sure that there's a very fun and great brand in crypto, but then also a seriousness to it where it's like, hey, no. If you raise venture capital money, like you need to at some point build a business. Like if you want to be a unicorn, you should have at least $100 million in revenue. How are you going to get there? You need to sell something. You need some revenue. So just level setting that is really interesting. And I think a lot of even big VC funds had to change that strategy before they made exceptions. They were like, this person has no revenue, but they're going to launch a token. It'll be fine. And then all of a sudden, 3 months later, when everything crashed, they would email their founders being like, why don't you have revenue? Lay off 70% of your company. And so I think there's like this investor class that's relatively new across the board. Like no one's been investing in crypto for 50 years. It's all being figured out in real time. So I think that makes it very difficult to know like what's the guidebook on how to build a business here.
So what is the guidebook on how to build a business? What's your best advice for first-time founders in this space and also for investors as well? Since like you said, no one is really like an experienced investor in Web3 because it hasn't even been around for so long.
Totally. And I think like a lot of it I'm figuring out as I go, like just by having conversations and seeing which companies are at peace because they're like building very consistently and which ones are having a lot of trouble at the early stage. I mean, my first piece of advice is do not build for VCs. I think a lot of founders do that. They're building for their next fundraising round. So they're trying to hit milestones. They're like, well, if we do this, then I can get this fund to invest and give me more money. Like now you're just participating in almost like a Ponzi, right? Like you're trying to do something to get more people to come into your company, but like that doesn't translate to the core product or problem you're solving. So I think that's one piece of advice. I think the second is, again, borrowing from the Web 2 folks, pivot if you need to. I'm not saying pivot out of crypto. I'm just saying if you had a thesis on a business and you tried to build it and nobody wanted it, find something else. I see a lot of founders hanging on to this vision or saying this will happen in the next bull market, but there's no data backing that anyone wants what they're selling. It is so much better to pivot than be stuck in this like no man's land. It will drive you insane and it's really frustrating and you're just like burning money. And then the third is stay lean and don't worry about your valuation. I see a lot of founders that are comping to bull market valuations when they're fundraising and they're like, well, this person raised at $60 million. This person raised at $70 million. I'm like, I'm pretty sure Coinbase, all these big, massive companies, their early valuations were all sub $10 million. It was like $5 to $7 million, right? Like all of these companies made that massive businesses and they weren't precious about valuation. And I think, again, there's this game that I believe a lot of these VC investors, they know that the founders they're backing are top in everything, right? They've gone to like Stanford, they worked at the biggest tech companies. They're always used to being like number one in everything. And so they've almost like used that to their advantage and gamified it, right? It's like, oh, well, you want to raise from our fund because it's a high signal. Like this concept of anti-signal if XYZ fund doesn't participate is insane. That's a made up construct for the VCs to protect their power because they need to defend why they are managing so much money to their investors and to the whole society. So there's been this whole game that's been created around making founders feel like, oh, we're the Ivy League of funding. Honestly, get the cash from whoever. It could be your neighbor. It could be a crowd fund. I have nothing against that. That doesn't matter. What matters is, can you build a good business? Your job as a founder is to get the capital you need to build the V1 of the business as fast as possible. This concept of like smart money versus dumb money happened because there was an influx of capital. And so when there's an influx of capital, supply demand, people needed to differentiate who do you get capital from. When there's not an influx of capital, you cannot worry about these things. Like you need to be in wartime CEO mode. We need money. This is what we're going to build. We're going to create a lot of value. Each dollar invested needs to become $10 at some point in our business and keep it going. And if our idea doesn't work, cool, pivot, next thing. I need to see more of that in this space. I think a lot of the young founders that came up crypto native have not had anyone tell them that to their face directly. So to me, like I'm pretty aggressive with some of those strategies when I'm chatting with my portfolio companies.
Beggars can't be choosers in a bear market. We're all beggars right now. What about for investors? I've started kind of angel investing in some Web3 companies, and I have a lot of friends who've started that as well. What advice do you have for investors? Because I mean, I'll be honest, like my investment strategy thus far has been like invest in friends that I really believe in. But beyond that, I think it's hard to know, like sometimes a project can seem like a really good idea, but it's hard to know if this is the right time. I feel like timing is such a big part of it. And maybe the number one reason why projects fail today is people are just too early, I think, to a lot of things.
For angel investing, I think the one rule is make the same size check. So almost like think about your net worth and then say, okay, I want to put this % into angel investing. And that percent can be like 1% or 10%, whatever that may be. It's based on where you have edge. You have your risk-free investments and you have one category that's high risk, but it's where you have edge. If you think you have a good founder network, definitely it's worth doing. But the mistake I see people making is like they'll invest like 1K into this friend because they're like, oh, I'm not sure about this idea. And then they'll put 50K into this company and another company because they're like, oh, like XYZ big brand name fund is the lead, right? And they like totally have a weird portfolio construction. You have the same odds essentially across the board. Like 1 out of 50 will become $1 billion business. So like do $1,050 checks rather than like trying to optimize it because you're not a fund, right? You're just writing checks. I think investing in people you trust and friends is great. I think early stage investing is all about people. The thing I look for a lot at like a pre-seed or angel level is founder market fit. So like, why are they building this business? This is a big big issue in crypto, I find. A lot of the whys are because we can make a lot of money in the next bull market. Like that's literally the why. Or, oh, I think I'll be able to raise money, so I should do it. Why not? That never works. Those companies always fail because like there's no passion behind it. So when it gets hard, they're the first to leave. We're seeing this now. Like you'll start to see more and more teams kind of fall apart, co-founders leaving, all of the above. Like there was no why and why crypto. So that's one thing I believe is like really understand, like, did they work in this industry? Did they have a pain point before and they feel like they have an unfair advantage? That's the most important thing, I believe. So that's like how you think about which founders to back. The other strategy is like I drop the minimum so I can have my friends put in $1,000 and get exposure to 50 companies that like I'm working full time on managing. It's really funny. Like no one ever asked me to invest in their fund. I was like, I would be down because I think it's a great way to see a ton of companies at once. You get to read the investor updates like every quarter. You get to like be part of this ecosystem. And I think if I was a billionaire, I would back a lot of funds where the manager has some edge, whether it's like they have the best deal flow or they worked in this industry that is very hard to understand, whatever that may be. I think exposing yourself to someone who's going to be bundling all day, like it's worth it. So that's what I think around investors.
That's a good strategy, actually, to invest into funds instead of into specific projects.
Exactly. If you actually do want to become an investor, I think there's a clear path. What I would do if I was starting right now and I said, I want to have like an exposure into investing, I would back a bunch of funds, see what they're up to. And then the companies you think are winning, you can go create SPVs for them. So now you're on the cap table with that fund manager. Or if you can get connected to the founder, being like, hey, I'm exposed to you via this fund. Like I'm really bullish on what you're doing. I've been reading about you via this fund manager for 2 years. I think you're about to like hit this exponential growth. Can I put some money in? And then you yourself can go bring all of your friends and say, hey, can we put in 100K, all of us together? It's very easy if you care and if you take time. I think what most people do is they wait for a milestone. They wait for XYZ big fund to do a big round. And then it's like all hype. Everyone's competing.
All right. I know we're at time, so I'm going to do one quick question from Twitter. This one is from Karsten. He wants to know, basically, if you could build a super app or platform or service or protocol or whatever with all of your portfolio companies, what would it look like?
Oh, interesting. So I would actually build, I didn't know that. So we have this Telegram group chat called the Spice Jar, which is very elite. I love it. And something I was thinking about maybe for future funds is it would be less of a protocol. I don't think I need to build a protocol, but there's definitely a services element to investing. Like I'll write a check, but then there's a lot that you can assist or amplify around the startups, whether it's they need help hiring, they need help doing their branding and go to market, they need help marketing, they need help operationally, they need help with legal. Like there are all these services that need to be taken care of. So something I was thinking about is what if we took the Spice Jar and in the second fund, like made all the Spice founders have an ownership stake in the fund so that they can help the next batch. So like they're almost advisors of the next batch of 50 companies and help out with some of these services. So that way you can scale your impact. And like each of these founders have different networks, have different strengths, have the benefit of having gone through it before they know what not to do. So like this concept of participation, growing the pie together is really compelling. I've been thinking about ways to do that.
And then for our last segment, explain your tweet. This is where I pull any interesting or ambiguous or spicy tweets from you. Most of your tweets are, I'll say, not super spicy. You tweet about your portfolio companies and it's all pretty wholesome and great. I did find one from May 17th where you quote tweeted someone else and you just said spicy take. And the original tweet that you quote tweeted is from Imad, who said, early founders who are not already wealthy should probably take early acquisition offers. In my last startup, we started in 2009 and could have sold in 2011. Instead, we decided to go for a home run. Took us another 5 grueling years to get an exit, only 2 times bigger. There's this whole thread, but that was the tweet. So did you think this was like a spicy take in like a good way or like you didn't agree with it?
Well, so I have a small fund, so I can, in a non-biased way, I can advise them to take an acquisition and it can still be a good outcome for my fund. Whereas maybe your bigger lead would not. So I can like be closer to what's best for the founder and still fulfill my fiduciary duties than maybe like a bigger fund. So, I mean, this ties back to valuations and founders building for outcomes and like unrealistic expectations. If you are a first time founder, you know, like a lot of businesses forget that sometimes it's easy to get from 0 to 1 million ARR because you've exploited some small advantage advantage and you can grow really quickly. To go from like the 1 million to 100 million means you have to be in the right category at the right time. So when we talk about the TAM, or we talk about how big is this market and timing, the way you brought up, if you're not at the right time, even if you have the best product, the industry total amount of people that can give you money isn't ready, right? And so in that scenario, I think as a founder, taking the win is totally worth it, because you have to have a sense of reality of, hey, am I going to be able to get this from 1 million ARR to 100 million ARR? And if not, wouldn't you want to take the bag? Like, why not? Right? And make all your investors happy, make all of your early employees happy. I think it's worth doing, but it requires a sense of self-awareness that I feel a lot of founders don't have in it. And sometimes they don't need to have. Like, if you're too practical, you might miss out on big opportunities as a founder. Like, there's a sweet spot. Like, you need to be a little bit delusional. You need to be a little bit convinced. But I think a lot of people shut down very good offers for $10 million, $20 million, and largely because they think they can build something bigger and like end up failing. And they don't even entertain the offers. And I think it's a miss, because you can literally sell your business and build another one with all the insight and build something with even bigger impact. A lot of big founders that you see that people look up to have had 1, 2, 3 of these smaller businesses where they kind of learn start to finish. And when they got acquired, they learned how the game works at a bigger scale. Like, oh, I get acquired by $1 billion company. How does this dynamic work? And so you can kind of understand, how does it work with a company that is doing $100 million in revenue a year? What are they doing? So you kind of learn, and people are missing that. So yeah, it's not spicy in a bad way. I think it's a good thing, and people need to be realistic. Now, if you raise at an insane valuation in your pre-seed round, those offers are usually off the table, because it's like a down round if you get that acquisition. That's another reason to be realistic with your valuation and not use that as your North Star.
Well, Maya, thank you so much for joining us today. Tell people where they can find you if they want to follow you, and where people can go to learn more about Spice Capital. Tell people if they're able to join now or sometime in the future, especially if they're a female or a person of color listening and they really want to be part of this thing that you're building.
Awesome. So you can find me at Maya Bakhai. That's my Twitter. And you can subscribe to our hot sauce reading list. It's hotsauce.beehive.com. It's in my bio. And that's like the Spice Capital weekly reading list where we go into weird rabbit holes. And yeah, if you're interested in investing or learning more, or how do I angel invest, feel free to email me at maya@spicecapital.xyz. My inbox is open.
Amazing. Thank you so much again, Maya. Thank you everybody for tuning in. And we'll be back again next Thursday with another episode of Rehash. Thank you for tuning in to this episode of Rehash. Rehash is hosted, produced, and edited by me, Diana Chen, and sponsored by Lens, LivePeer, Quest, and Lore. Rehash is also supported by our community of NFT holders who curate our guest lineup each season. To get involved, head over to our website at rehashweb3.xyz and collect this episode as an NFT. Anyone who collects an episode becomes part of the Rehash community and will be able to nominate guests for future seasons. To learn more about how to become a guest on the podcast, go to rehashweb3.xyz/podcast. And to learn more about sponsoring the podcast, go to rehashweb3.xyz/sponsor. Finally, be sure to follow us on Twitter, Instagram, and TikTok at rehashweb3 or on Lens at rehash.lens. And don't forget to rate, review, and subscribe on Apple Podcasts, Spotify, or wherever you get your podcasts. You can work for yourself without doing it by yourself. When you go independent, you need to constantly engage your network and update your professional profile, but the tools we use to do this haven't evolved in the last 20 years. Quest makes it dead simple to gather support for a new idea, broadcast updates to your network, and showcase your best work on your profile. It's one link for who you are and what you do. Sign up at rehash.quest.com to follow along with our quests so you never miss an episode, or you can create your own quest today.